There we go, let's dive right into it. My name is Marco and I'm the co-founder of Vinter Capital, where I am leading its legal department. So Vinter Capital is a crypto index provider. You may know about stock index funds. We're doing the same but for crypto. So let's see, let's change this one. There's the team. There we go. In 2017, OECD and Credit Suisse, they conducted a study on the impact on blockchain technology across a multitude of different industries. They created a rate called the blockchainable portion of an industry. How blockchainable is a given industry? Public health, real estate, and communications were identified as highly blockchainable. And there is one industry who stood out the most. The financial industry was identified to be up to 100% blockchainable. So I would bet that many people don't have a very detailed understanding of what distributed ledger technology actually does, and specifically in the intersection between traditional finance and this new emerging market. In many ways, we see something I call duplication of industries. We're seeing blockchain or crypto equivalents to established institutions in the traditional financial space. This impacts our laws and our financial markets. So I'm a corporate lawyer, and this will be the focus for today. So there are a number of different areas where this could have implications. Contract law, tax law, international law. Before I entered into the startup life, I was a regular lawyer at a big business law firm. I was operating in a group specialized in data protection, amongst other things. So naturally, when we discussed blockchain and it was all over the news, or actually Bitcoin, the data protection implications of this technology was something we discussed a lot. So my interests are mostly in corporate law. So that's the angle I'm taking today. So I want to talk about the corporate law implications of blockchain. I will do this by telling two stories. I want to tell one story about the history of stock clearing and settlements markets, and the other story will be about blockchain technology and how it's currently used to either replace or reform existing institutions in traditional finance. After that, we will connect traditional finance with blockchain to see what interesting implications there might be. So let's start with the first story. What happens when you buy a stock? How do you get the legal rights, what you as an owner of these stocks are entitled to? How do you get dividends? How do you get voting rights? These kinds of questions are often surpassed by most people and find them uniquely boring. It may be way more interesting to dive into the front-end strategies. How do we make money? What are the latest smart alpha strategy algorithms? But once you get the stock, people don't really care about what happens next. How do you take that stock and get the right to vote to get dividends? But I think there is an interesting story here. So if we go back to the early 1900s, buying and selling stocks was not much different than buying and selling a used car. When a corporation issued stocks, they would issue share certificates to their shareholders, which were physical documents showing the ownership of that stock. It's not that much different than the registration certificate you have for your car. So when you as a shareholder decide that you want to sell your stock, you would dig the certificate out of wherever you put it. You would send it off to the buyer. First, you would stop by and get it notarized by a notary, and then the buyer would send this paperwork to her broker, and then finally send it back to the company. Then the company would normally use a transfer agent who would validate who is the owner of the stock and at any given time, and then they would cancel the old certificate, take it back, and then send a fresh certificate back to the buyer. So this is the oldest and most traditional way of stock settlement, and generally worked okay for about 50 years. But with increased trading volume, the system was not efficient due to all the paperwork in order to settle and clear the stock. Thousands and thousands of clerks were hired eventually, and they started to fall behind days and even weeks. And a number of failures arose from this when they couldn't figure out who owned the stock. Sometimes share certificates went missing. This mess created situations where large financial corporations used this situation maliciously. For example, one Lehman Brothers analysis at the time concluded that the following: well, okay, we have $475 million in security whose owners we can't locate, and we own $220 million in securities that we cannot find. And then they just kind of mixed that. And that was a problem. So more than $400 million in stock were stolen or by organized criminals during this time, actually. And at the height of this crisis, all financial markets closed on Wednesdays just so the brokers could try to catch up all the old paperwork and sort out the piles and piles of certificates that clearly wouldn't work. So eventually, regulators and financial markets agreed to a new system around the concept of share immobilization. So let me explain how this system works. This is what we're used to today, and we use this across all the systems across the world, including here in Sweden. So we have a company, let's call it BitConnect, that decides it's going to issue some stock. Instead of sending out certificates to the individual investors, BitConnect will issue the stock to a centralized entity in Sweden where we use something called Euroclear. Euroclear will then be the formal record holder of the stock, when the actual investors will be treated as the beneficial holders of the stock. But Euroclear is going to hold on, to all the rights in what's called unidentified fungible bulk. They're not going to distinguish among the different types of certificates. The actual owners will be known again as the beneficial holders. And so, for example, some of you may be familiar with angel funds, such as Propel Capital or other VC funds, who invest on behalf of of a bunch of angel investors. So if Propel decides to buy shares in BitConnect, it will be designated as the beneficial holder of these shares and should get all of the legal rights of ownership. But Euroclear will still be persistent as the record holder. When they're ready to sell their shares, they will contact the broker and say, we'd like to sell our stock. They'll find someone to buy the stock, and then eventually the shares will be transferred to the buyer, not physically like before, but through an accounting adjustment, through bookkeeping adjustment. So it happens that the buyer also is represented by the same broker. The broker will just make a bookkeeping adjustment to reflect these facts. And then the beneficial ownership has been transferred from Propel over to the buyer. So the broker, let's say it's Avanza, and Avanza's records will just show in its books, and will just reflect the fact that money goes from buyer to the seller, and the beneficial ownership goes the other way around. The main point in this is that the system with specific shares is not the system of today. Specific shares are not identified in the system. And the ones that are in Euroclear, they are fungible. So it could be any shares that are transferred when someone buys the shares. And this is today's settlement system. So there are a few problems with this system. One problem is just increased complexity and transaction costs. So if you think about it now, every time a company wants to hold a vote, say for an annual director elections or for anything else, we've got to work up and down through the various layers of intermediaries, trying to figure out who actually owns the shares, who has the right to vote on the stock, and how to process those votes in any way that takes an excessive amount of time. And it's in this complexity, sometimes there are a number of instances when, for instance, more stocks has been voted than there even exists. This is obviously very problematic. And as a matter of corporate law, another set of problems stems from the fact that some rights in corporate law actually require some identification. We need to know whether the shares you own qualify for a certain type of rights in a way that really can often be indeterminate. So let's say you have A or B shares. That's a problem in this current system. So if I, for example, want to file a lawsuit alleging that a registration statement has been fraudulent, you may need to demonstrate that the shares that you owned were the ones that were issued in connection with the fraudulent registration. And as I've suggested, that might be impossible in a world of fungible books. It's an indeterminate question, but corporate law still uses that inquiry in order to figure out whether you qualify for those rights. So say differently, we've arrived at a clearing and settlement system that mostly works. It solves the paperwork, but corporate law has paid a bit of a resulting price from this complexity. Historically, because we've tracked ownership information of corporations through general ledgers, and that's how we track where a corporation owns. And these are really different in comparison to a distributed ledger. This is where blockchain technology really shines. Because a corporation's ledger is private, most people can't view it, and also it's limited in perspective, and it only shows what the corporate itself owns. It doesn't show the entire ownership history or universe of a given collection of assets with a distributed ledger. So with a distributed ledger, we actually have a network that's established where it's akin to the property registration system. And all of the ownership history of a given collection of assets is updated and recorded in a relatively real time. That gives you information on who owns what, and collectively, and what's been the history of the asset ownership. Over time, you can think about this like a real property recording system where there are thousands of individual participants, each of which have been and have the right to modify the records, and then once the modification has taken place, these rights are broadcast and mirrored throughout the industry and throughout to all the participants, such that you don't have to go down a dusty government office and look at who's the history of owners are, or you can just look at the distributed ledger and try to figure it out just by looking at that. This system is maintained through blockchain technology, and the history is important to understand how we can learn from it going forward. So where are we now? So let's say I want to go and buy crypto, but not Bitcoin, Litecoin, or any single asset. Let's say I'm super bullish that the crypto market is here to stay, but I don't want to pick a winner. On the crypto market, I would buy an index token. Where do I buy this asset? Ideally, I would go to a crypto exchange. I would buy the token from the exchange, but the exchange itself is not actually holding the tokens or the underlying cryptos. Instead, it's been transferred through a market maker who is in charge of maintaining what's referred to as the exchange hot wallet. The market maker often also acts as the exchange custodian for the crypto, and they hold it for them, and it makes it accessible for them. So let's say I want to withdraw this, and I could withdraw this to my own crypto wallet. Then I could go buy things or trade it with other people, sending it to their crypto wallets. All of this I'm describing is a duplication of existing models, actually, in the traditional financial market. If you want to be a market maker in traditional finance, you will need to have a license and fulfill liquidity requirements under the Markets in Financial Markets Directive, the MiFID II directive. Crypto exchanges in EU are not regulated as regulated markets, OTFs or MTFs. But to issue the same token I described before in a way that you can access this on your everyday Avanza or Nordic app, you would need to be either a regulated market, an OTF, or an MTF. All of these who are regulated under the MiFID II. If a bank would want to offer custody services to crypto, they would need a license under the Mutual Funds Act. And I have actually some interesting anecdotes from this. So the company I'm working for is a crypto index provider, and we provide indices both for regulated and unregulated companies to create index products, both on regulated markets but also on exchanges. And we have a collaboration with one of the largest Swedish banks, and they told us that they actually created a crypto wallet for their online bank. So most of you probably have this app on your phone right now, and they have an existing crypto wallet in their app, but it's not published, and it won't be published probably until one big player goes first, because this is what is the main point from big players. They see a reputational risk of going into this space, and no one wants to be first. Banks don't lead, they follow, as you could say. And this is very true for this bank. So they have everything in place. They have a department for crypto. 11 people are working there, but they have not launched anything. So let's continue. So if you want to create a crypto index product, you need a regulated index. You need to be a regulated benchmark administrator under the EU benchmark regulation. Let's see if we can. So digital ledger technologies in the global financial system is still in its early day, but it has endless potential, of course. And decentralized finance has what it takes to revolutionize the financial sector and can address multiple growing concerns with traditional finance. But the paradox with a parallel system is that the crypto space today is that many times not easy, scalable, or understandable for everyday users. So to enter into this space, it's quite hard, it's quite difficult. And by learning from our history, we can find ways forward. So I believe that implementing blockchain solutions in traditional finance can result in widespread gains. And decentralized finance will first have to address a number of issues pertaining to scalability, security, liquidity, and regulation, if it is to replace today's financial system. But the application of this technology in the intersect with traditional finance can result in a more decentralized and transparent economy with far-reaching positive effects, such as financial inclusion for everyone. Thank you. I'd like to take some questions. Okay, so Vinter Capital is right now, we are an index provider, and we have applied to be a regulated index provider by the Swedish FSA. We sent an application in September, so it's ongoing right now. And by 2020, all asset managers who right now are issuing index funds, this applies to both crypto index funds, which does not really exist in unregulated markets, but also traditional index funds need to have a separate company providing them with indices, so they cannot be calculating their own indices. This comes from the LIBOR scandal, when basically banks were both holding assets, calculating how much the assets were worth through their indices, and then also getting paid through a percentage of those assets. So they were basically calculating how much they would get paid themselves. So this was a problem, and in 2018 this new regulation came into force, and from 2020 all the asset managers need to be compliant under this regulation. So we're looking forward to 2020 basically. So Vinter Capital actually comes from, we were founded at the midst of crypto winter, and also we're all from Stockholm, so it was a reference to Stockholm. So both a combination of our roots, but also a reference to when we started this journey. So when we started, people thought we were crazy, but times have changed. Yes?
Can you hear me? Oh,
sorry
for screaming.
Yes, great.
I think in the crypto space, we have a lot of different regulatory frameworks.
Yeah.
which are inconsistent to each other a little bit. So
Yeah.
everybody speaks, I think the word of last year was the regulatory inconsistency as such.
Yeah.
When you try to follow some kind of a regulation within Sweden, from where do you get your information saying which type of regulatory framework it's the most important that you're supposed to be following? To just give an example, there's a mismatch, for example, when it comes to the GDPR and the Article 18, they're actually forgotten, of course, versus the MiFID regulation on the data protection, versus how long you're supposed to be keeping and tracking data of your customers and actually completed financial transactions with you from an accounting perspective. Just show you one of the problems.
Yeah. So.
And then it's like a difficult. Then you cannot really ask the regulator. The regulator tells you it's a risk-based approach, which basically means nothing. And how do you navigate further?
So in law we have something called the conflict of norms, and also norm hierarchy. And what we learn back in law school is that we have a hierarchy of regulations, of laws, of more or less binding provisions. So what we need to do in this specific case, we have a principle called the lex specialis principle, which means that the more specialized regulation always applies. This is a general principle, which means that if we have two regulations that on the hierarchy on the same level, then the regulation which is the most specialized applies. Then it comes to, okay, but what is the most specialized regulation?
In this particular case, it's very difficult.
Yeah, and in this case, of course, and many times it is. Then we have to go and look into what does the EU court say, and what does the national court say, and then we have to go back and see, are they saying the same thing? So it's a legal essay to do that, and this is oftentimes not taken into account by people in the blockchain space, that the legal part is utterly important, and these qualifications, if you could call them, are not to be taken lightly. But you have to do them, and you have to motivate them, because at the end, is the best motivations who wins in law. It's not right or wrong. It's just the best motivation.
Correct.
This argument.
Do you have a possibility to speak with the regulator? Because in Sweden, the regulator doesn't have the mandate to enhance the financial market. They have the mandate to enhance the financial market in other jurisdictions, Singapore, Malaysia, etc. But how do you know? Because in this particular case, we don't have court cases. We just have a paper from Oxford and a paper from Cambridge, which are contradictory to what is important.
Yeah.
And you sit there with like.
So let's say you wanna interpret something like the GDPR says, then you would probably be looking at what does the Swedish data inspection say about this specific topic, and then also you would see what does the European Data Protection Board have said about this, and what does the working what is it called? A working group within GDPR said about this, because there was a working group before the Data Protection Board. So you will be asking them to see, and if you don't know, then this should be solved through a process. But most of the times, you can find guidance at least in the different statements from, let's say the MiFID regulation is not only a directive and a regulation. It's 13,000 pages of, first of all, the directive, the regulation, working papers, delegated directive, delegated regulations, statements from the Commission, etc. And all of those are binding. So you will have to manage those, and even experts in MiFID have read like 10% of those. So that's good to know.
What's your view on the FATF guidelines that are coming into effect?
In what sense?
The transfer rule, particularly.
The transfer rule? I don't really know.
It's when you need to track the transaction, you need to do data sharing with the other broker participants.
Oh, you mean the data portability? What do you mean?
Yes.
Yeah, I understand. So the data portability rule, Article 40 in the GDPR. No.
FATF guidelines.
So we have the Swedish Financial Supervision, then we have ESPA, the European Security Market Agency, then we have the Financial Action Task Force, which is doing recommendations. They have released, of course, a recommendation on crypto. Recommendation is not a regulation. And then it says that whenever a cryptocurrency exchange broker would like to execute a transaction, And this way, the broker has to get the information from a wallet provider. As a wallet is a software, it's a kind of difficult to build things on top of the blockchain protocol, as an example. So then suddenly we have a regulation which is completely nonsense that's maybe a strong statement, from a technical perspective, but it will be implemented by June 2020. So I think that's
I would love to discuss that further. I feel like this is maybe not as general as for everyone to discuss, but let's talk about that further later.
It's really interesting that you mentioned that, like, because there is not like one measure. It doesn't matter if it's just a software, and then you have to keep it track. In the banking world, there.
But maybe there's something that we should be discussing afterwards, because it's connected. Every time when you see a transaction on a blockchain, you can see it, but it's not that you see a transaction on a blockchain suddenly with your personal number next to it. And this is a little bit what the regulator would like to do, but with actually this the intention, because they maybe have been afraid based on Libra. That's a very subjective perspective, but we don't really know how this is supposed to be executed in practice. So you create a blockchain, and then you create a blockchain personal data transfer system. Yeah, good luck with it.
Traditional banking, they have to do that. If you're just doing their
correct, but they are not on a blockchain.
I know.
So, I mean,
I understand that.
There are companies like Netkey that are looking at moving on a protocol layer. So let's say you're using a Bitcoin wallet, that the local Bitcoin wallet would identify you as a person, and they would have a protocol exchange with, let's say, Hello, where we could then see that this person is fully verified. So then you can transfer that information.
Then my question was actually related then you can't be under laundering compliant with all.
No, you can. Definitely you can, because then you verify the identity of all of the different transactions that are coming in, and then you do your KYC. I think this is not the issue. It's more technical.
This is a really interesting conversation. Let's go to the bar with it. Okay.
Perfect. Do we have any more questions?
We need to invite the next speaker, Niklas, because we were just kicking us out in about
Niklas,
35
you are
minutes.
very welcome to join me on stage, and thank you all for listening.
Thank you.